I think we're living through the biggest structural shift in venture capital history, right? So thank you for having me on. The best companies on this planet, they're going to stay private for 20 plus years because that's where they can build without any noise. But here's what most people are missing. This isn't just about IPOs being delayed. This is about a fundamental rewiring of how value gets created and how liquidity gets accessed. We've spent 11 years building this infrastructure for this new world while everyone else was chasing this old playbook. When I helped that Facebook employee with their options problem in 2009, I had no idea that I was witnessing the birth of $1 trillion asset class. But that's exactly what happened. The companies that figure out how to provide sophisticated liquidity solution, whether that's through secondaries, structured tenders, or whatever comes next, those are the ones that are going to win. Because at the end of the day, you can't have innovation without the ability to reward the people that are building it. And if the public markets aren't going to do that job anymore, then we're happy to do that. The secondary market isn't just some niche corner of venture capital. It's becoming the primary mechanism for value realization in the private markets. And honestly, I think we're just getting started.
This is the 1 Point Podcast, and I'm Rohit Yadav. We recently released a comprehensive ecosystem-wide report called as Rethinking Venture Capital, a strategic lens, in which we explore the entire value chain of venture asset class. Now, within this overarching strategic report, time and again, I explore themes which are complementary and with people who have tons of experience as venture experts. So today, I'm absolutely thrilled to have Jared Carmel, founder and managing partner of Manhattan Venture Partners, with me. I've been chasing Jared for this recording for a few months now, but as many times it goes, I didn't get a chance to speak with him till now. So I'm glad he's joining today and talking to us about all things secondaries in venture and MVP, which is short form of Manhattan Venture Partners, as a venture capital firm. Quick background, Jared is a founder and managing partner, as explained, at MVP. They have pioneered the institutionalization of venture secondaries since 2014, which is a long time back in the secondaries world, trust me. And under his leadership, MVP has grown tremendously from a startup to over more than 1.5 billion AUM. He's also the GP of MVP All-Star Fund. We'll talk about that. And Bloomberg ranked All-Star Funds number 2 and 3 in the top 10 best performing VC funds under 500 million AUM in 2025. So that's quite a win. And on top of that, that's not all. On top of that, PitchBook named MVP as a top 5 US secondary investor. So all the good things are happening. Jared, thank you so much for joining in. You're the perfect guest to talk about this topic of secondaries. So I would love to dig in right away. Tell us, what is MVP first?
Sure. Well, thank you for having me. And sorry you had to chase me. It was, a long, hot summer. Manhattan Venture Partners, it's a platform business, right? So there's 4 interconnected pieces that all feed into making us better investors. We've actually been credited for institutionalizing this asset class. We've, like you suggested, been doing it since 2014. So we sort of have an 11-year head start on most people. And really what makes us different is that we solve the liquidity problem for late stage companies that are stuck in, call it the private market trap, right? We have this land and expand strategy where we enter in about the Series C round, then we expand through secondaries. And what this allows companies to do is remain private until an optimal exit point. But for our LPs, we delivered with this strategy top decile returns that are 3 times faster than traditional venture. And I think the numbers really tell the story, right? $1.5 billion of AUM. We have 2.2x average net DPI with an under 4-year hold period versus the industry VC average of around 13 years. Our track record is north of 18 IPOs, so 19 if you count Klarna, and 6 strategic sales. And we've been in companies such as Coinbase and Palantir, Spotify, Airbnb, DraftKings, and so on. But the current portfolio spans, I think, a lot of deep tech leaders, whether that's Anthropic or XAI or lesser known companies like Kodiak Robotics or Hawkeye 360 or Rapid SOS or Agility, but also we're in transformative companies such as like Epic Games and SpaceX, Klarna and Revolut. And what enables this is our integrated platform, right? We have the All-Star Fund, that's our core business, where we land in those primary rounds. Through our advisory section, our secondary as a service business, trademark, we expand through structured liquidity programs. And then we run institutional transactions through our trading desk. And that's where we see real-time market data and pricing for large institutional transactions. Plus, I think you'd know this, we have Manhattan Venture Research, which provides us 16,000 subscribers. You can find us on Bloomberg terminals, which has really become an interesting lead generation tool for us. But here's the key. All of this data flows back to making us better fund investors. And for our LPs, they get unique access and great returns. And for our portfolio companies, they get the liquidity that they need and the access to our LPs, who are some of the largest industrial families in the world, and it helps access their international markets. So really the punchline is that we're connecting institutional capital with what I like to call tomorrow's IPOs today, and we're building liquidity infrastructure one company at a time.
Amazing tagline, tomorrow's IPOs today, plus congrats for Klarna, right?
Yeah, no, it's that was an amazing journey. I'll definitely talk about that throughout this conversation.
So, Jared, you have been into this since 2014, founding and building Manhattan Venture Partners. How has your journey been as the founding member from ground up? The emotional side of it.
So honestly, it was in the early days, it was the pure Wild West when we started.
Okay.
My first transaction, because that's what it was in the space, was in Q4 of 2009, where I helped someone at Facebook with their liquidity problem. They were
Okay.
leaving, they had options, they needed to exercise and pay these taxes. And that's when it clicked that there were tons of people in Silicon Valley and the world at large that had this exact problem. So initially, we tried democratizing this space with a fintech company called Citizen VC. And me and those partners, we really didn't see eye to eye in strategy. And openly, they sort of pushed me out the door, which was one of the most challenging moments of my life because I left a cushy spot at a company that's now called G Squared to pursue it. While I was at G Squared, I ran their secondary markets. I was responsible for a lot of the early success in their first two funds. But I would say, I'm a glass half full guy. So the cool part about being at Citizen was that we helped write the SEC regulation called the Citizen VC rule in
Okay.
2015, which clarified how private placements could work with an online platform. So we pivoted, me and my partners that were there, my partner Eric and my partner Brad, into institutionalizing this asset class instead of trying to democratize it. And honestly, for the large part of 11 years, both on and off, it sort of felt like a solution, maybe in search of a problem, right? Today, I think we've had that problem, and that's, it's loud and clear. I don't think you can listen to a podcast or read anything about venture capital without secondary market coverage. The early days were brutal. I know it's cliche, but we were three guys in a small room that was the size of a closet. We felt like frauds every single day. However, we continued to see structural liquidity needs, and the confidence began to build over time. Today, we're 30 plus people across 7 cities, a lot of AUM, billions of dollars in transactional volume. Sometimes I pinch myself, how did we get here? But honestly, about the emotional side, what keeps me going every day is a bit of imposter syndrome. I feel like we're not
Okay.
supposed to be in this seat, but here we are. So I'll never take any of this for granted, especially after 22 and 23, where everybody thought that VC and private equity were dead.
Okay. Thanks for sharing the emotional side of it. I want to move to the bigger portion of the journal secondaries market, and I want to start with the most pivotal question: is the current hype around secondaries in the venture justified?
So I think it is because here's what's really happening, right? The total addressable market has exploded. So we're not just talking about more funds chasing the same deals, right? We're talking about the underlying fundamentals have shifted dramatically. No one's ever cornered the market on good ideas, right? So look at this progression. Your average time to IPO in 2000 was 3 years old. Those were your Googles, your eBays, your Amazon. In 2021, that jumped to about 13 years. Those are your Twitters, your Airbnbs, your Klarnas. And Klarna, as we were just talking about, it just went public, right? That was a 17-year-old company. So my prediction and my thesis going forward is that the best companies are going to stay private for 20 years. They're no longer startups. So you sort of heard that you heard that here first. But here's the kicker. There's now 15,000 mature VC-backed company versus only 4,300 US publicly listed companies. That's a crazy ratio. And there's over 600 billion in undistributed value sitting in funds that are hitting this 10-year mark over the next several years. So what's fascinating to me is the institutionalization's happening, right? Every major investment bank, whether it's Citi or JP Morgan or Morgan Stanley or UBS, they all have a desk for this. Some are chasing assets for advisors. Others are positioning for IPO mandates. But look at the economics. OpenAI is in the middle of doing a $10 billion secondary right now. At the end of the year, Databricks did a $15 billion round with also $10 billion with secondary. So if you were
Mhm.
one of these Wall Street banks, would you rather be in the billion-dollar Klarna IPO business, or would you rather be in the $10 billion secondary at business? So with that said, that means the secondary market's grown at like 4 times over the past decade to almost 70 billion. And what most people are missing is that institutionalization's happening. The secondary discounts have compressed from 55% to 13%. To me, that's institutionalization in real time. I think the wild west of this asset class is
Mhm.
now becoming Wall Street, right? Or something a little bit more fundamental.
Understood. So you clearly are saying this is not a hype. This is kind of a necessity and the maturing of the market, institutionalization of the market, and going where the opportunity is. And which what it has done, it has also led to funds, secondary funds forming and popping up in the space recently. So do you think there are too many funds right now in the space?
I'll keep this short and sweet. The answer is I don't. And going back to what I said, which was nobody's cornered the market on good ideas, look at how many companies are actually out there. Everyone has a different thesis. There are index funds out there who are just indexing the private market. There are what are called 40 Act funds or mutual funds, like the guys at Liberty and so on, that are publicly traded. I think there's room for a lot more players because there's the liquidity need and the total addressable market here has grown, right? So, and in fact, I don't see any of this as competitive. I see it as creating a foundation for the future because the only way that this market is becomes institutionalized is by having enough liquidity providers that exist in this market, having
Mhm.
the fundamental sort of base coming from the big banks, having the CEOs and founders of these companies on board, having Silicon Valley become these venture capital investment banks. There is only one way that this market truly institutionalizes, and that's that everybody, gets on board.
Got it. Understood. And you touched upon this perspective on discounts, and you mentioned 55% from 55% to move to the 13% number. So there's always this talk of also the spreads between the bid and the ask, supply versus demand. Where do you see this in 2025, like right now? And where do you see this headed next year, maybe?
That's a really good question. So, besides the fact that we are living in very exciting times, I think AI has grabbed all the headlines and investor focus. But what's happening in secondaries is very similar to what's happening in the S&P 500. All the action is in the top 10 names, while there are amazing companies that are getting neglected, right? So everyone wants their OpenAI or SpaceX or Anthropic or XAI, et cetera. But the real opportunities are in those excellent lesser known businesses. These businesses would be A plus late stage venture backed companies in any other era, but they're getting overlooked really because of all this AI frenzy that's happening. So here's where supply and demand get interesting. You could find a secondary seller who, first off, understands that their junior security should trade below the primary round. When you look at a company, you have their most recent round of funding, and you have what's called the 409A, which is the valuation at which they're issuing their options to their employees, right? So there is two price points that sort of exist. And I think the informational asymmetry that one has when you're an investor in one of those companies is that, you understand that business and you're not just investing on the hype. Plus, over half of the late stage rounds now have some sort of secondary component to it, right? Where it was just 20 or 30% just a few years ago. And to me, I think the supply is about to explode. If you ever heard Charles Hudson, who was the former National Venture Capital Association head, he was suggesting that selling stock in private startups is going to be as high as 80% of all the, call it, dollars that's going to go back to LPs over the next 5 years. So when you have this 600 billion plus in undistributed value hitting fund expiration dates, you're looking at a massive secondary supply that could be coming online. And again, I think what most people are not realizing is that VCs are sitting on record dry powder, but primary rounds are declining for the fourth consecutive year. So, and the time between rounds just hit 2 years for the first time in a decade. So you have all of these funds that are looking towards secondaries to deploy capital, but traditional VCs are only capped at 20% allocation outside of primary rounds, which is due to the SEC private company exemption.
True.
And that's when, and that's really why I would say many of the largest VC funds are becoming registered investment advisors or VC investment banks. This will allow them to expand their abilities, including getting heavier into secondary allocations.
Okay. So both the supply side will boom, or there'll be massive growth in that due to all the things that you pointed out, DPI. There's a lot of inbuilt momentum within the sector, but there are not enough exits when you talk about IPO and M&A, for example. And there's demand side, obviously VCs converting into registered advisory firms and so on. So there's demand matching as well. Can you maybe briefly tell about the LP demand for secondaries? Is it growing? Is it stagnant? Demand for secondary funds, for example.
So I think LP demand is the largest it's ever been, right? This asset class has sort of come out of these shadows and into the mainstream. So what we have happening right now is you have everybody chasing those top 10 names. And so, every family office internationally has sort of professionalized now. You've seen the sovereigns move from investing in funds to now investing, by themselves directly into these companies. I think today what you're seeing is this understanding that a lot of the future growth is going to happen in the private markets and all the alpha is going to be generated there. So you're seeing all of these institutions and families start to move downstream in order to get access.
Got it. So let's go one level down, which is the dynamics of secondaries, right? And you touched upon this a couple of times by mentioning the discount rates. And you also mentioned there are, let's say, a handful of companies which are trading on premium versus many, many, many others which are trading on discount. Similar to what we are seeing in the public markets, there are a handful of companies with generating the return in S&P 500, and rest everything kind of is relatively flat. So when we talk about secondaries, do you see this trend continuing, or because of the institutionalization, the topic of supply and demand, you see this compression within the discount? That's one. Maybe you can touch upon this very briefly. And then the second question to the same thing is there are two sides, two thought processes within the ecosystem right now. One says if a company is on discount, it's for a reason, so don't go for discounts. And another is we only want to go for the premium, for example. So where do you fall in this kind of bucket?
So the first thing I would say is that there's sort of been this bifurcation for years. If you look at the early days of the secondary market, the Facebook, LinkedIn, Twitter days, they always traded at premiums. There were no discounts, right? There's always been hype cycle stuff. People paid any price for Uber and Airbnb 5 years ago. So it's always had this extreme momentum names versus everything else. And here's where we make money, everything else, right? You just need to understand the businesses first. And so that leads me to another problem, which I'm sure we could touch on at some point, is the fact that you need information on these businesses in order to be successful in that segment of the secondary market. And that's how we ultimately deliver returns to our LPs. Land in primaries, understand the business, bring our cost basis down through secondaries. Take companies like Hawkeye 360 or Blue Voyant. Lesser known businesses, incredibly exciting, solving huge problems, but they don't have that open AI gravitas. So that's where I throw my support. Structural liquidity needs, employees who might have left, early investors needing DPI, all of this putting pressures on the CEO or founders. So to me, the bottom line is we act as that pressure relief valve for that founder of that company. Shares go into a friendly hands. Founders get to do their jobs without the noise or need of potentially becoming a public company or selling their business prematurely.
Got it. So you nicely explained that. One point that you mentioned about the employee and the founder. So I want to double down on this. This employee founder share sales was used to be frowned upon. It doesn't used to happen so much, but now more and more it's becoming a bit of an essential part of running a healthy startup. If you can explain the dynamics of how you see this part of the market changing and what is the attitude towards RSUs and ISOs in specific.
Sure. So I think that the dynamic had to flow, right? Again, in the Facebook early days, there was a lot of it. Then in the Uber days, there was less of it. Then it started to bubble back up again. And then now you're hearing some of the largest rounds saying no SPVs, right? Basically saying don't resell, be a principal, right? Which totally respect that. And I think watching this transformation has been fascinating because companies like Palantir, DocuSign, Facebook, Lyft, Twitter, they blazed this trail early. They understood that these were essentially an off balance sheet bonus for their employees, right? But here's the structural problem that needs to be solved. It used to be you worked at one of these companies for 3 or 4 years as a startup. Then it went public on the NASDAQ. So from 23 to let's say 27, you lived a very normal lifestyle. The company went public and now you were rich. Now companies stay private for 15 years. So you go from 23 to 38. We were talking about this in sort of the lead up here together. Your life changes, right? You might get married, you're going to have kids, you have a mortgage, you have student loans, right? The math is brutal. And so most companies, or rather, I would say most employees with options are probably the least diversified people in the room. Imagine calling up your financial advisor today and saying, I want to put everything in Apple Computer, right? One stock. He would tell you that's a terrible idea. You're not diversified. Now imagine you're 23 making $100,000 a year. You live in San Francisco or New York. You have 10, 20, $30 million in options in one company that's private, right? So here's where it gets critical. And if an employee leaves, they have a very limited window to exercise those options. So once it's exercised, they owe income tax on those shares, even if they don't sell it. Think about that for a second, right? So a public market option, private market option have two things in common. There's an expiration date and there's a strike price. So employees face this horrible choice. They either need to find the cash to exercise. Once they exercise, they have a giant tax bill, or they let these potentially valuable options expire worthless. And you touched on RSUs. They're even trickier. They have this double trigger structure, time vesting plus liquidity event. So when companies begin using RSUs around year 5 with 7-year expirations, by year 12, those RSUs are starting to expire. And even though the company is still likely years away from an IPO, they start to run into some real pressure. Stripe, Databricks, they proved that these solutions work, right? We talked about the $10 billion Databricks, but Stripe did a $6.5 billion structured round. So 2 of the largest in venture history happened in the last couple of years. They waived their RSU second triggers. They used primary capital to buy back employee shares for tax bills. Then they organized tender offers for the remaining equity. It's really becoming the playbook if you're a successful late stage startup. And the reality is, if equity grants keep expiring worthless, then these companies can't attract top talent. That threatens innovation itself. And so again, I said this before, but my hypothesis is the best companies are going to remain private for 20 years before going public, which starts to make employee liquidity programs a mission critical component of any founder and any playbook that you have at a later stage startup.
You explained everything beautifully. So yeah, I mean, it's amazing. You captured all the points in the puzzle of employee founder and why it exists, along with the story of the recent Databricks.
Stripe. But I'll add one thing that we haven't talked about because I think it's important. Some of the largest venture funds, they do continuation funds, right? When they have that one asset left in their portfolio due to what's called the power law, right? So you get to year 12, 13, or 14 of your fund, and you might have your one winner sitting in there. What about all the angel investors over the last 15 years? Many of them started funds. They don't have the ability to create continuation funds because they don't have that network. Those single asset holders that want to launch their next fund or whatever, they need to provide liquidity to their LPs, and there's no liquidity in sight. It's a less emotional market than the rest of them, but that is a huge and ever growing market that is starting to become a real problem in venture capital.
Understood. Let's go one step down and talk about your fund, MVP, the All-Star Fund.
Favorite
And
topic.
sorry?
My favorite topic.
Favorite topic, right? So what's the strategy around investing in startups with a 1 to 4 year exit horizon? I think you touched upon briefly initially, but if you can expand on that.
Sure. 1 to 4x in 1 to 4 years. It's kind of the inside joke, right? So that's the target. And how does it work? So we are able to be directionally very late stage in companies, but then, as suggested, bring the cost basis down through secondaries to a much earlier valuation, right? It is a very interesting playbook that has now worked 3 times over. We're still investing out of Fund 4, and we're in the process of closing Fund 5. And what we look for is market and technology validation. We look for diversified revenues. We look for profitable or funded to profitability. We look for, call it, well-capitalized businesses through multiple rounds from, I would call them tier 1 VCs as defined by MVP, I would say. But here's what most people miss. A disproportionate number of winners come from a very small handful of top funds. And these value signals truly drive deal flow. Top talent, operational expertise, deep pockets, all of that reduces the funding risk. So our process is have a thesis on a sector or a market, find a company that's done about a Series C, then invest alongside some of the top VCs. The dirty secret about being in secondaries this long is that 10 years ago, 12 years ago, 13 years ago, we provided liquidity for folks who now run the best companies on the planet, or they're at some of the largest venture firms today. Those network effects compound. And when you write somebody a check when their options were about to expire and they're now able to preserve their net worth, you're now friends.
Friends for life. Understood. Okay, Jared, tell us about the distressed sellers, the disruptive company, and the fallen unicorn approach of investing. It sounds all like buzzy word, right? But you have used that in practice. So why do you think it's relevant in today's environment?
We've done a lot of good work on buzzy words in the secondary market because nobody else was doing it, right? Tomorrow's IPOs today, secondary as a service, land and expand, distressed sellers, disruptive companies, fallen unicorns. I should be trademarking all of them, but feel free to use the ones that are not trademarked out, other secondary market folks out there. But distressed sellers, disruptive companies, that was my fourth fund's thesis back in 2019. And it's been proven incredibly persistent.
Okay.
We saw what I called the global rise of populism, right? In 2019, if you put that hat on, right, you had this movement through Latin America, you had Brexit, you had the US elections, plus you had the accelerating debt across the world. Right? We saw those chickens come home to roost recently. You had what I thought was a bad Italian fiscal policy that I thought was going to break the European Union. You had problems out of China, problems out of the Middle East, problems out of Eastern Europe. Honestly, it looks like 2024. But our hypothesis was simple. Any one of these could have triggered a US recession or correction, forcing sort of these large cap private companies, these unicorns, to start to cut costs, lay off employees, and create this supply and demand imbalance in the options market, right, for secondaries. And this would then exacerbate that RSU problem we were just talking about because companies had to stay private longer. And then that fund DPI issue thing that I touched on would get even worse for later stage funds. And here's where patience started to pay off. We only invested so by the way, my wall of worry that I just talked about, I did not have global pandemic on it in 2019. So we were right for maybe the wrong reasons, but our patience really did pay off. We invested only about 12% of the fund during that zero interest rate environment or the ZIRP environment versus most deploying, I would say 40-ish% based on the data that we have. The balance went to work in very late 22, but mostly 23 and 24, where we wrote our last check recently in 2025. And that discipline should drive significant outperformance versus our vintage. So if you think about my market, there's sort of this inverse relationship with what's happening. So in good times, there is a convergence on the pricing of secondaries to primary rounds. In bad times, there's that divergence, right? So what you need to look for are companies that could manage that challenging journey that you're on, but when you get to the destination, are still incredible businesses. And I would say that the perfect example of all of that was Klarna, right? Just went public, great IPO, valued perfectly. So it didn't have a giant pop. So all of the returns were segmented to the founders and the employees and the investors. But in June of 22, they did a significant down round of financing. And that was a issue that wasn't anything to do with their business model. They had a banking license requirement and they needed to raise a lot of capital just at the wrong time. We love
Okay.
the business fundamentals. So we backed the truck up, as they say, and we made our largest position well into the 9 figures. With their recent IPO, I think we were vindicated on that call. But the broader pattern that we identified was that well capitalized, high valuation businesses would either fall dramatically in the secondary markets or potentially do flat or down rounds. And that created opportunities to enter high quality companies at big discounts, right? Distressed sellers, disruptive companies. We weren't betting on failure. We were betting on a temporary market dislocation that would affect these fundamentally sound businesses.
And how do you see this environment right now as of today? So, like, if you have to project things into future, do you see this strategy of distressed sellers, disruptor company? By the way, I love the the slogan here. Do you think it's still executable? And what makes it possible? Because you're talking about the macro things, which makes entirely sense into this overall puzzle of venture. So, how do you foresee the future?
I think right now the future is challenging. If you zoom out for a second, you have a declining middle class in the United States. It's just a fact. You have declining buying power of the US dollar, right? You have the global stage changing in a way that we haven't seen since the 60s. On top of that, you're seeing the market price gold at all-time highs. So we're also potentially going to, cut interest rates. I think it might already be priced into the market even. So we live in this interesting sort of paradigm. And so ultimately, I don't have a crystal ball. I think we'll get a few more years. I don't think we're going to go through that full 7-year cycle that we normally do in the US, right? Because I think what we'll see is a few more years of excitement before something in the macro picture really starts to affect, the US markets. Unlike
Okay.
10 or 15 or 20 years ago, we've become more of a global village and we're all very intertwined with each other, probably for the first time ever. So it's very hard to tell, but as suggested, the good news about having dedicated pools of capital going after these incredible assets is when the market changes in the venture capital world and the multiples start to change, it affects the sellers of those assets first, not necessarily the companies who might have a very large war chest and can live through an 18-month recession or bear.
Understood. And with respect to this macro picture, where do you see these IPOs? Do you think they will come back to us to a certain extent? I think they are back in some degree, at least in fintech, if we can talk about. But overall, would the IPO market be back? And if the IPO market is back, it being one of the exit routes for the venture capital business, do you think this impacting the secondaries market then?
So I'm really cautiously optimistic about the IPOs for the next couple of years. I don't think it's going to be an opening of the floodgates that many people might have expected. And again, sort of my contrarian take here is we might see IPOs from companies that can't raise the funding to fix their RSU problems rather than companies choosing for an optimal time to exit.
Okay.
And again, I think what's fascinating is that IPOs are fundamentally changing, right? So you have all this secondary capital in IPOs that jumped from essentially zero in the year 2000 to 17% in 24. There were 24 times more secondary capital raised in 24 versus 2000, but only in half of the primary capital. The average, I would say, 2024 IPO had $60 million in secondary proceeds versus only 300,000 in 2000. So let
Mm-hmm.
me translate that. IPOs are becoming clearinghouses for liquidity rather than primary capital raising events, right? So that
Uh-huh.
structural shift, I think, strengthens the secondary market's role rather than diminishes it. But the reality check that we're living with right now is that you have 750-ish unicorns, right? I
Unicorn.
don't love the term, but it is the term, with over 420 that are already 10 years old. So if only the oldest unicorns IPO first, and we return to sort of historical IPO pace, it would take 17 years just to clear the backlog of 10-year-old unicorns, right? Wild.
True.
So
True.
during that time, these companies keep aging and their shareholders keep demanding liquidity. So if we fast forward to 2030 under our assumptions, and you have almost 580 companies that are still 10 plus years old, that are significantly expanding the addressable market for secondaries, I think the math becomes sort of undeniable, right? So even if IPOs return, I don't think they fundamentally solve the liquidity needs of this massive cohort of mature private companies. So if anything, it continues to validate our thesis that secondaries become the primary mechanism for private market liquidity. But again, I'm optimistic. I'm invested in companies. I think liquidity is key to this market. And even in a robust bull market of IPOs, there's still secondary opportunity. So I'm pro IPO, regardless of it negatively affecting my business, because I think it's good for everyone.
Okay, so there's no stopping secondaries now.
That's the
Understood.
punchline. You got it.
Okay. So, what would be one emerging theme? Because you talked about distressed sellers, disruptive company. What is one emerging theme, according to you, which is the most underpriced in private markets as of today, and why?
Good question. Most people ask the opposite, but the opposite's so much more obvious. So thank you for asking. I think the headlines right now are dominated by themes like AI, security, and defense, which are attracting massive capital. And I think what's underappreciated is the underlying physical infrastructure that enables everything else, right? So if I had to be specific, I don't think I could give you one, but let me talk about a few that I'm excited about, which is and call it energy efficient semiconductors, right? Or non communication satellites, or trucking, or emergency response, or alternative energies beyond the obvious renewables and nuclear plays. Plus, US manufacturing for this nearshoring or friendshoring trend that I think has just started. But here's where I think we're seeing the real opportunity. There are companies that are solving critical infrastructure problems that don't get those AI headlines, right? Take Rapid SOS, which is rebuilding the emergency response infrastructure. So when you call 911 from your phone, their platform automatically sends your precise location and medical data and other information to those first responders. That's life or death infrastructure that most people don't think about. Or one of my favorite companies, Hawkeye 360, is doing something similar with RF satellite technology, right? They're tracking radio frequency signals from space to identify everything from maritime trafficking to military movements. They're essentially providing the eyes and ears for national security that you can't get in any other way. Or platform science, which is, I would say, tracking connected vehicle infrastructure. Their operating system for commercial fleets is the Android for their vehicles. Or I don't know, Agility Robotics and the humanoid robot space. They're the first company to deploy humanoid robots in live operations with multi-year commercial agreements. We're talking about the $42 trillion manual labor market. If you look at the recent jobs report, we need help in warehouses ASAP. And these companies are building the physical backbone that enables the AI revolution that everyone's chasing, right? Whether it's
Mhm.
energy grid bottlenecks, whether it's emergency response systems, whether it's logistics infrastructure, that's where the real value creation is happening while everybody else fights over this application layer in AI.
Got it. Thanks for outlining. Last question from my side. What are the top two, three things that can unlock more transparency, institutionalization, and liquidity within the secondary market? So we are still talking about the predictions, but you want to focus on secondaries as a asset class itself.
Sure. You know, after a decade and a half of doing this, I can tell you that I don't believe there's going to be a technology solution. Might be controversial. A lot of money is poured into it. I think most technologies are a solution that's still searching for their problem and ever iterating um, with no real near term outcomes. Most of them are just glorified brokers, right, that are burning capital trying to figure this market out. I think the biggest problem is lack of information flow, right? It's easy to say I want to own OpenAI or Anthropic or SpaceX or any of these momentum names that you want to own because somebody else has owned it. But that's not how you fundamentally invest in any class, in any asset class ever in human history, right? Until companies start to share their confidential information with the broader market, we'll have this aggressive sort of great wall separating momentum bettors from professional investors who don't want anyone else in their club. So I think informational asymmetry is really a barrier, and I don't think that gets alleviated anytime soon.
Okay, understood. So Jared, thank you so much for covering like such deep thoughts on secondaries. Do you have some final thoughts on this?
I do. I think we're living through the biggest structural shift in venture capital history, right? So thank you for having me on. The best companies on this planet, they're going to stay private for 20 plus years because that's where they can build without any noise. But here's what most people are missing. This isn't just about IPOs being delayed. This is about a fundamental rewiring of how value gets created and how liquidity gets accessed. We've spent 11 years building this infrastructure for this new world while everyone else was chasing this old playbook. When I helped that Facebook employee with their options problem in 2009, I had no idea that I was witnessing the birth of $1 trillion asset class. But that's exactly what happened. The companies that figure out how to provide sophisticated liquidity solution, whether that's through secondaries, structured tenders, or whatever comes next, those are the ones that are going to win. Because at the end of the day, you can't have innovation without the ability to reward the people that are building it. And if the public markets aren't going to do that job anymore, then we're happy to do that. The secondary market isn't just some niche corner of venture capital. It's becoming the primary mechanism for value realization in the private markets. And honestly, I think we're just getting started. So really, thank you very much for having me. I really enjoyed our conversation.
Well, Jared, thank you so much. With those impactful words, I would say thank you so much that you joined and cover such a large breadth of details on the secondary markets. Thanks.
Talk
Take
soon.
care.